When you're analyzing a real estate deal, there are a lot of metrics to consider. And one of the most important ones is the cap rate. And in this video, we're going to break down exactly what a cap rate is, how to calculate it, and why it matters to you. If you're new here, I'm Dr. Jeff Anzalone, a dentist on a mission to get you to the point that work is optional. I have a free passive income training, links below this video. All right, let's start off with answering the question, what is a cap rate? So if you're a new real estate investor searching for the best deals out there, you're going to hear the term cap rate being thrown around. Basically, a cap rate is a way to measure the return on a real estate investment based on basically what it's worth, its current market value. It's used by people like realtors, appraisers, brokers, all those types of people to evaluate property. Now, knowing how to calculate and use it is important because it's going to help you to assess and compare different investment properties. All right, let's answer the first question. How do we calculate a cap rate, okay? Simple. Cap rate, we use this formula. Cap rate equals the net operating income divided by the purchase price or divided by the property's value. I own a lot of RV parks and mobile home parks, so we're going to use that as an example. So we're gonna have an RV park, and we're gonna figure out what the cap rate is. And we know from this RV park that the net operating income, so you have the gross income minus expenses, that's the net operating income for this particular park is $96,000. All right, and then the purchase price is going to be $800,000. So we divide $56,000 divided by $800,000, and we will get our cap rate. And that's going to equal 0.07 times 100. Basically, it's going to be 7%. What does this mean? Well, this means that the RV park has a cap rate of 7%, which indicates the annual return an investor can expect on the property based on the purchase price. Now, how do you calculate this NOI, this net operating income? Well, as I just mentioned, you want to subtract out all the operating expenses from the property's gross income. Typically, this could be taxes, repairs, insurance, any type of management fees they may have, utilities, payrolls, etc. Now, it's important to remember this. Mortgage payments are not included in the operating expenses because why? Depending on the buyer, they can vary. So the cap rate actually allows investors to compare properties without being influenced by any type of individual financing terms. Now, cap rates can help investors evaluate and compare different properties. So let's say like a 7% cap rate. What this means is you can expect to earn 7%, a 7% return annually on that particular property, assuming that the NOI, the net operating income, stays the same. Now, here's one thing that you should remember. A higher cap rate usually indicates higher returns, but it also comes with more risk. Higher cap rate, typically higher returns, higher risk. Same thing with the lower. So if you have a lower cap rate, what do you think? This often means that the property is in a prime location. So if it's in a prime location, it's going to have less returns, but it's also going to have less risk. So for example, if an RV park has a 7% cap rate and another one that you're looking at has a 5% cap rate, well, of course, the 7% cap rate property offers better returns, assuming all factors are equal. Okay, it's just kind of an easy way to look. Think of it like this. If you were to buy a property in all cash, that is what the cap rate tells you, what the return is going to be. So for instance, for this particular RV park, if you paid all cash for that, you can expect a 7% return. And then if you look at another one with a non-cap, well, then you can expect a 9% return if you were to pay all cash. So that's a way that you can judge between the two. All right, now cap rates can also be used to estimate a property's value. So if you're looking at different properties, let's say in your mind, you want to buy something at a 7 cap rate, okay? You want to buy that's sort of your buying criteria. Now, we could do this. We could take the property's value and we could change this up right here. Property's value equals the NOI divided by that cap rate that you wanted to purchase at. Okay, so we'll use this example that we've used before. We know on this particular park, let's say that they've listed it for whatever. You know, let's say they listed it for $1.5 million. Well, when you get the financials, you see that the NOI is $56,000, and then in your mind, you want to buy property at a 7 cap. So what you could do is you could take the $56,000, the NOI, divide it by your desired cap rate. Guess what that equals? So that gives you what you want to pay. Okay, this is going to allow you to quickly determine if what they're asking, if the asking price actually aligns with their expected returns. Now, typically as the cap rates go up, the property values go down, and it's an inverse as well. As the cap rates go down or they're compressing, the property value, or actually the price, goes up. So the lower the cap rate, the higher or the more expensive the property is. The higher the cap rate, remember the higher cap rate, higher risk, the higher the cap rate, typically the lower the cost. All right, so that's kind of an easy way to look at it. So for example, again, let's use this RV park example. Right now, it's at a 7 cap, $800,000. All right, so let's say that this cap rate, it was 7%, and now it's going to drop down to 5%. You bought it, you've done some improvements, that sort of thing. It's dropped to 5%. So you're thinking, okay, what's the new value? We'll just plug in the information. So but let's assume that the NOI stays the same. All right, so that'll make it easier for you. So if the NOI stays the same, we take the $56,000, and before we divided it by 7 caps, so now we're going to divide it by, it just went down to 5%. Now this is worth not $800,000, but $1,120,000. So you can see from this example, so this shows that a lower cap rate really increases the property's value. It's an inverse effect. So I hope that example helped. Now, and I mentioned about adding value to a property. Well, how do you do that? Well, just think about you just make improvements. So if you make improvements to a property, you can actually increase the NOI because you can charge more. If you can charge more, you can raise the rents. Well, you can increase the value. Well, what can you do? Well, you can, depending on what type of property it is, you could paint it. You could improve the landscaping. You could pave the roads, or if there's potholes in the roads, you could improve the roads. If there's fixtures, if you have a single family home, if you have an apartment building, you can update the fixtures. You can add things like you can add laundry facilities. Some of our RV parks, we have added cabins, we have added restaurants or bed and breakfasts, things like that. Anything like that we can justify raising rents. We're not raising rents just for the sake of raising rents. We're raising rents because we are improving where somebody lives, giving them a nicer, safer, cleaner place to live, and thus we can raise the rents. So let's talk a little bit about limitations, because yes, cap rates are a valuable tool. They are going to have some limitations, and it's like a snapshot in time, because cap rates reflect returns for the first year only. Real estate is a long-term investment, and income can grow over time. But again, the cap rates just show typically just for that first year only. Sellers or brokers, they actually might go in and they may, and I've seen this before, they'll manipulate the expense reports. So it's very important to verify the numbers, verify the expenses, because that could play a huge role. Cap rate should be one of just, not the only metric you look at, but they should be one of several metrics that you look at when evaluating a property, okay? Not just the only one. So again, cap rates are a powerful way to analyze real estate deals. They help you to compare different properties when you're looking at them. They help you to assess the risk and then calculate the returns. So by understanding how these work and going through the motions, you practice calculations, you're going to have more confidence when you're actually analyzing deals that you may want to invest in. Now, as you heard me a little bit earlier, we've talked a good bit, and we've used RV park examples, which is one of my favorite asset classes. And if you want to learn more about how to invest in them and just more about them in general, check out this video.